Most Americans follow financial advice for years. Many still feel financially tight every single month. Traditional financial advice was shaped in a different time in America. Jobs were more stable. Living costs were lower compared to income. Career paths were straighter. Today the economy moves faster. Costs shift quickly. Income patterns are less steady. Yet much of the advice sounds the same. One common rule says to save a fixed percentage of income. That works only when income stays steady. Many people today work in commission roles, contract jobs, small businesses, or performance-based pay. Monthly income can move up and down. A fixed percentage rule becomes stressful during low months and unrealistic during unstable periods. Another popular rule pushes homeownership as the main wealth strategy. Housing can support long-term stability. But housing in the United States carries ongoing costs beyond the purchase price. Property taxes rise. Maintenance never stops. Repairs appear without warning. In some states, insurance costs have increased sharply. When housing takes too much of monthly income, flexibility disappears. Without flexibility, small disruptions feel heavy. Traditional advice also focuses heavily on cutting small expenses. Cancel subscriptions, skip daily coffee, cook at home. These habits help at a surface level. The largest pressure in most American households comes from housing, healthcare, transportation, and taxes. Adjusting minor habits does little if large expenses stay unmanaged. Another weakness is career assumptions. Older advice assumes long-term employment in one field. Today, many professionals change industries multiple times. Technology replaces certain roles. Entire sectors slow down while others grow. Income paths are rarely straight. Advice built for one long career track struggles in this environment. Investment advice often centers on long-term holding. Over time, markets have grown. Yet markets move in cycles. During weak periods, account balances can fall. If someone needs access to funds during that time, stress rises. Without strong cash reserves, long-term plans get interrupted. Liquidity is one of the most overlooked factors. Many households place most savings into long-term accounts or property. On paper, net worth may look strong. In daily life, cash may be tight. When medical bills, repairs, or job changes happen, people scramble. Short-term reserves protect long-term growth. Healthcare adds another layer. Medical expenses in America can be high even for insured families. Deductibles, co-pays, and uncovered services accumulate quickly. Financial plans that treat medical costs as small surprises underestimate real exposure. Education costs also affect long-term planning. Tuition and related expenses can run high. Families sometimes overcommit to funding education while weakening their own financial stability. Balance matters. Traditional advice also assumes calm decision-making. Real life includes stress. When markets fall, fear rises. When markets rise fast, excitement takes over. Emotional decisions damage progress. Without clear systems, behavior becomes inconsistent. Cost awareness is another missing piece. Fees inside investment accounts, fund management costs, and service charges reduce long-term results. Many people do not review these details regularly. Over decades, small percentages reduce growth significantly. Income strategy is often ignored. Most conversations focus on saving more. Fewer focus on earning more through skill upgrades, strategic job moves, better negotiation, or business ownership. In a high-cost economy, income growth supports long-term strength. Geography plays a powerful role in the United States. State taxes differ. Housing costs differ. Job markets differ. A move from a high-cost state to a moderate-cost state can increase disposable income without increasing work hours. Location decisions influence long-term financial direction. Family structure has shifted. Some households support both children and aging parents. Some delay major life milestones. These realities require flexible planning. One-size-fits-all advice does not adjust for personal structure. Transportation is another major cost area. In car-dependent regions, fuel, maintenance, insurance, and replacement costs absorb large portions of income. Living closer to work reduces long-term expenses and saves time. Traditional advice compresses all of this into short slogans: save early, invest long-term, buy property. These ideas sound clean. Real financial life is layered and complex. Financial strength in modern America requires active cash flow management, strong liquidity, controlled risk exposure, and ongoing income positioning. Plans must adjust as life changes. When traditional advice fails, it fails quietly. Progress slows. Goals feel distant. Stress grows in small amounts over time. The solution begins with replacing rigid rules with flexible structure. Money must be managed based on actual income patterns, real expenses, and personal risk exposure. Clarity improves control. Structure improves stability. To understand why traditional financial advice often falls short, look at how money actually operates inside an American household. Income is rarely smooth. Some people are paid hourly. Some earn commission. Some run small businesses. Some receive bonuses tied to company performance. Even salaried workers face job changes and industry shifts. When advice assumes steady income, it ignores real volatility. A practical financial structure begins with clear separation of expenses. First group, essential survival costs. Housing, utilities, groceries, basic transportation, necessary health care. Second group, stability costs. Childcare, education, professional development, communication services. Third group, lifestyle costs. Travel, upgrades, dining, entertainment. When income drops, adjustments begin with the third group. Survival costs remain protected. This structure reduces panic during lower income periods. Liquidity remains critical. Many households show strong long-term investment balances, yet struggle with short-term bills. Their money is tied up in assets that are meant for the future, while daily cash stays tight. Accessible reserves covering several months of essential costs provide protection during job transitions or unexpected expenses. Without available cash, people may be forced to sell assets during weak market periods or take rushed financial decisions that damage long-term progress. Housing decisions require disciplined math. Monthly housing cost should leave room for savings and flexibility. If housing consumes too much income, every other goal becomes harder. Location, commute distance, property taxes, and ongoing maintenance all affect total cost. Income growth deserves structured focus. Professional development increases long-term earning power. Skill upgrades, certifications, technical knowledge, and leadership ability support higher compensation. Negotiating salary at each job change significantly impacts lifetime earnings. Side income can strengthen stability when aligned with existing skills. Consulting, specialized services, or digital offerings built around professional expertise reduce dependence on one employer. Tax awareness increases retained income. State residency, business structure, and legal deductions influence how much money stays in the household. Reviewing tax positioning annually prevents inefficiency. Risk management must be separated by category. Employment risk requires emergency savings. Market risk requires long-term planning and diversified allocation. Health risk requires dedicated medical reserves. Business risk requires operating capital buffers. Treating all risks as one general concern leaves gaps. Spending discipline prevents lifestyle expansion from consuming income growth. When income rises, increasing savings first builds long-term strength. Gradual lifestyle upgrades keep finances stable. Geographic strategy can improve financial outcomes. Some states offer lower housing costs or tax burdens. Remote work has increased flexibility for many professionals. Choosing residence based on cost efficiency and job opportunity can shift long-term results. Education planning requires careful evaluation. Field of study, job demand, and total cost matter. Funding decisions should align with expected income potential and household capacity. Transportation costs deserve attention. Long commutes increase fuel, maintenance, and time loss. Living closer to work reduces both direct expenses and stress. Healthcare preparation reduces financial shock. Setting aside funds specifically for medical costs limits disruption when unexpected bills arrive. Measurement creates awareness. Monthly review of cash flow, quarterly review of major expenses, and annual review of net worth provide direction. Without review, spending drifts and goals blur. Digital tools can support structure. Automated savings transfers, categorized expense tracking, and scheduled financial check-ins reduce emotional decisions. Economic cycles require patience. Strong growth periods should not encourage overextension. Slower periods require steady discipline rather than panic. Balanced planning handles both environments. Business ownership offers growth potential but requires operational control. Clear accounting, cash reserves, and conservative expansion protect stability. Family planning influences long-term cost patterns. Timing of children, schooling decisions, and housing size affect decades of spending. Estate organization protects dependents. Updated documentation ensures assets transfer smoothly and according to intention. Financial media often highlights extreme outcomes. Sustainable progress usually comes from consistent structure, controlled spending, and steady income growth. Professional networks influence opportunity access. Strong relationships increase job mobility and business growth potential. Traditional financial advice fails when it reduces this complexity into basic slogans. Modern financial stability requires layered planning across income, expenses, risk, geography, and skill strength. Simple advice sounds attractive. Structured systems produce results. When cash flow is organized, liquidity is strong, risk is layered, and income strategy is active, financial pressure decreases, control improves, confidence improves, progress becomes visible.